Hi everyone, my name is Freddy and I'm making this video in English for the Gexbot community on Discord. I've been chatting with few guys and they have few questions, right? And I told them I'm gonna make a video to try to put some concepts of these kind of methodology to trade with the gamma profile, with the gamma levels. And then I told them I just gonna explain the way I see it and the way I trade in the market. And hopefully it's gonna be helpful for them because I know there are a lot of guys who came in new. They hear about Gexbot and they hear about how good it is, right? And we are futures traders, right? And there is a lot of concepts and a lot of information from the options market that is a little bit difficult to understand, to be honest. But having said that, with Gexbot, it's very easy to trade, and I'm gonna show you today how easy it is to trade with this tool, right? And basically we have to do it in an algorithmic fashion. Basically, this tool helps us to trade NQ with tight stops and kind of bigger targets. Opposite to what usually we hear that, oh, when you trade NQ, you have to have large stop losses because it moves a lot. Now, we don't do like that, right? And I'm gonna show you how. And I'm gonna show you my trade on Friday. It was a very good one. But first of all, what I'm gonna do, I'm gonna try to review some concepts first, right? Why is so important to track the options market, right? Why is so important that we track these gamma levels? Well, first of all, I want to show you this table. This is the options from 2000 until, well, that was 2023, 2024, but you can see the trend, right? So basically, options are the largest driver for the whole market, right? You see the equity, the non-equity, and the futures, right? They are huge, um, and they drive the market. The second thing that I want to show you is this. Um, I believe the zero DT options started to trade 2022, right? So if you see the trend, have a look that in 2022, the zero DT options, which are options that open at 9 o'clock in the morning, 9:30 when the market opens, and expire when the market closes at 4 o'clock. 2022, they represent 12.5% of the total options contracts, right? These options are like 1 week, 1 month, 3 months, 6 months options. In 2023, they represented the 37.5% of the total volume. Last year, they actually account for 56.2. And if you manage to see the daily volumes, usually last year and this year is like every day, zero DT options are like 50% of the total value, the total volume of the options, right? So why is that important, right? It's important because of this. Well, I'm gonna start with the basics, with the basic concept, right? Um, what it is, right? So the client, they came into the options market, right? If they buy a call, which is this one, right? If they buy a call, the market maker, what happened with the market maker, right? Usually the market maker, they will have an inventory, right? So the market maker, um, he provides liquidity. So his job is to provide liquidity. His job is not to take the opposite side. Um, I mean, is not to like in the futures market where, there is a buyer in the futures market, right? We have a clearing house, and the clearing house match the buyer with a seller, right? So the market maker doesn't try to do that, right? If there is a buyer of an option and the market maker match it with a seller, it's fantastic for him because Where he made his money? He made his money when he charged a spread. So he charged a spread to the buyer, he charged a spread to the seller, right? And he also gets some money from the exchange rebates. But most of the time, this doesn't happen. Most of the time, there is a client who came and who came to the market maker and asked for a price, right? And the market maker take the opposite position. So when the client comes and buy a call, the market maker take the opposite position. So the market maker is short the call, right? The market maker, he doesn't sell this call. He put it in, he warehouse this call, and he needs to manage his rates, right? And the way to manage his rates is with delta, right? So he always had to be delta neutral. So delta is the derivative that tell him, listen, you are now short this call for this client. You need to buy, you need to buy contracts in the futures market, certain amount of contracts to be delta neutral, right? And as the price move up or down, gamma tells him now you need to sell or you need to buy more futures because the price has moved and you are no longer delta neutral, right? And that's why it's so important what these guys in Gexbot is doing, right? Because we are tracking this gamma, and especially the gamma imbalances or excess of gamma, and I'm gonna explain later on, right? So if we take this in mind, obviously, if the client comes and sell the call, right, which is the structure, the market maker will be long the call, and he will go into the futures market and sell the futures, right? Because he needs to be delta neutral, right? And again, as the price move up or down, gamma will tell him, oh, you need to buy or you need to sell more futures in order to be delta neutral. If there is a put and the client buys the put, so the market maker sells the put, he needs to sell futures to be delta neutral. And again, as the price moves, gamma will tell him to buy and sell. And the last one is if the client sells a put, market maker buys the put. He needs to be delta neutral, right? So he needs to buy futures. Either way, what you can see here is that as these clients came into the options market, the market maker takes the opposite position and he needs to hedge his risk by entering into the futures market and buying or selling the futures, right? So that's the first concept we need to have clear. Now, um, we know this, so the market maker take the opposite side, right? And what's important of this, right? So Gexbot say, all right, we know that these guys are gonna come into the market. The So we're gonna the first thing they did, and they did it in classic, but this one is very good in options profile. They classify. They say, okay, let's gonna put in orange the calls, and in purple the puts. So the orange on the left are where there is a selling of calls, right? It doesn't matter, and this is very important. Don't think of this, oh, this is the client, this is the market maker. No, these are excess of options. What it means is they classify everything to show us what is important. That's the simple concept, right? But in essence, when we have this orange bar on the left, it means that is selling of calls, which in nature are bearish, right? Because this client or whatever is doing is expecting the market to go lower, right? The purple on the left is selling of puts, which are bullish, right? In nature. Why? Because when you sell a put, you are expecting the market to go higher, right? And collect the premium. And same here with the call, you collect the premium. Now, on the right side, you go, the orange ones are buying of calls, which in nature are bullish, right? And you go buying of puts, which in nature are bearish, right? So why is this important? Why it comes into because why I'm telling about this, right? So Gexbot say, all right, we know this, we're gonna plot this, but we really need to understand it's not enough to plot all the options that came into the market. What we need to do, we need to find a way to only classify what's important, right? What has what they call high net convexity or excess of gamma, right? So the way to trade this Gexbot is, and this is how I do it, and this is why I learned from Jasper, is we do not interact in the market on the negative gamma. So on this, which is the gamma profile, what we have is we have the excess of gamma or high net convexity, which are these bars, kind of blue bars, right? So basically you trade here, you trade here, you trade on these levels, and I'm going to explain how in a minute. But you do not trade on the negative gamma, right? You avoid entering the market in these levels, right? And I put it here, do not trade here. The only level which I pay attention to and which is very important for me is the maximum negative gamma, right? Why? Because um, this is in the Discord channel. So the way to trade this, or the way to understand it, is as follows. If we have an excess of gamma, right, we do understand that an institution is coming into the options market to trade, right? And they usually came with these, not usually, but if they came with these big orders, right, and big volumes, and the Getbox actually identify them as an excess or high net convexity, basically we will see it like this. What it means is on these levels, they will affect the market and they affect the market, right? And the market do something on those levels, right? And basically these are kind of mean reverting. So if we think in volume profile terms, in what we see in this kind of technical analysis, what we want to do, we want to trade on the low value nodes, right? On these ones. Why? Because they are mean reverting. If the price is going up and they go to these low value nodes, they tend to be mean reverting towards the high value nodes. And if they manage to trade below, they will go to low value to the other area, to the other side of the low value node, right? We don't trade on high value nodes, which is the point of control. Why? Because this is the major concentration of the order, the trade, right? So you don't want to trade on these areas because usually what happens is you go short, and as you go short, the market quickly reverse and hit your stop loss, right? And if you go long, the market quickly reverse and you hit your stop loss, right? So this is the areas where you want to avoid with the volume profile kind of methodology. You want to trade on these low value nodes, right? Because you know they're mean reverting. So with gamma and the excess of gamma in Gexbox is exactly the same. You want the price to trade, for instance, if we're coming for below, you want the price to trade above this level, find a support, and then go to this level, and then eventually go to this maximum negative gamma, which is the high value node, right? And then if you manage to go higher, this is your target. And the price is very difficult that trades above this level because we don't have any gamma who goes above it. Think of it as a magnet, and the price kind of these magnets kind of pull the price towards them. And once they pull the price towards them, it kind of mean revert, right? Unless there is more levels of gamma that they tend to kind of pull the price. But that's why we only and only trade, as I put it here, we only trade on these high value nodes. We don't trade on these ones, right? So that's the concept which is very important to keep in mind. Um, so the guys on Guestbots, Jazz and John, they say, okay, what we need to find and we need to classify these levels where institutions came and they create this excess of gamma or high net convexity levels. And we want to see that because we know those are the levels where the price reacts. And I have a guy in, I was chatting with someone in Discord and he told me, oh, I like to see QQQ because, NDX is very difficult. And then they asked, why you guys use NDX to do the analysis and no QQQ? I believe, and the way I see it is QQQ, we know this is kind of a place for retails. If we see a table in an options platform, within the first standard deviation, a contract in the QQQ market, triple Q market, is between $50 and $400 within this standard deviation, right? So that's why it's the market for retails. But when you have a look at the NDX within the first standard deviation, the price of a contract is between $1,600 and $16,000, right? So clearly these are very expensive and they're only institutions which trade on these markets. And I call them kind of the intelligent traders and the ones who know what they're doing. They don't come to the market and they don't buy one contract or two contracts. They usually come with, 1,000 contracts, 500 contracts. So there is a lot of money, right? So that's why, and I believe that's why the guys in Getbox, they track the NDX and not the QQQ, right? Because they want to see when um, we have these here you go, high net convexity areas, right? They want to see when the big institutions came and they really have, they're clever. They have this kind of big, quantitative desk, economic desk, so they can come and say, okay, you know what, I want to buy this structure. I want to buy a call spread or whatever it is. What's important for us as a futures traders is to know that, okay, I'm gonna avoid to trade in these areas like between here and here, and I'm gonna wait the price to come to this high net convexity of excess gamma, right? Now, uh, the other concept which is quite important and I wanted to show you guys is this one before we go into the actual trade. I think this is called the volatility skew or the volatility smile. I'm not really sure how they call it in Gexbot, but basically what it is, this is the implied volatility for calls and puts, right? And the implied volatility is quite important because it's a component for the option pricing, right? So the way that I see it, and it was shared with us. So I'm gonna start with the first one because on Friday it was kind of vertical. You see, that was totally vertical. So according to this kind of explanation that Jazz explained to us and is in Discord channel, if we have this one like this, like we have on Friday, we have no hills, no valleys, and basically what it means is the price could easily go up and as well could easily go down, right? And if you think about like a ball, you have a ball here, it could go easily up or down, it could go either way. When you have it like this, the ball could easily go up, right? And when you have it like the downward slope, obviously it could easily go down. But if you have it in this kind of curved shape, it's very difficult the ball to go up. It's very difficult to go down, let's put it in that way, because these options are more expensive. So the implied volatility make these options quite expensive. So we get stuck in a range, right? But on Friday, we have this structure where the price could easily go up and easily go down, right? So keep that in mind. And now, how I traded, and to be honest, I kind of found the consistency a few months ago since I actually started to trade it in this way. So for me, it's quite important the daily levels in the graph, right? Because I know that, oh, well, I don't know for sure, but what I can see and what I have seen in the market is the in these levels, institutions came and defend the levels. So for instance, for Friday, I have 22,119 was my first level. Why? Because it was a level that found some resistance here, right? It found resistance on this day, right? So, and on this day, the price found resistance as well. It tried to break it, it came down and it closed below, right? Second level, which is important to me, is 22,007. Why? Again, same on this day, found resistance. On this day, tried to break below and found support, so resistance becomes support. Um, these days where they cross it, but on this day, look, it found resistance again. So it's resistance, became support, became resistance, and here it was resistance as well because the price tried to break it and quickly came back. This was on Wednesday. Um, well, this is Friday before the market opens, so it was around before 22,004. That was before the market opens. Okay. The third level, which was important for me, and I find levels which are kind of near the opening of the market, was this level here. Why? Because it found resistance on this day, found resistance of this day, price tried to break it, it couldn't, came back, quickly came back. On this day, found support to the tick, right? And on Wednesday, I went long on this level on Wednesday. So basically tried to break it and it couldn't. So it was kind of liquidity grab and quickly came back. So this 21,870 is quite important. Then what is important for me, I try to see the previous highs on a daily chart, right? Sorry, this is in Spanish, but this was the high 22,050 on Thursday, 22,093 on Wednesday, right? And again, the lows, same. I mark the lows from those days as well because they are quite important for me. Why? Because I have seen that on these levels, when I see the gamma, when I see excess of gamma, which is telling me, all right, something is happening on these levels, an institution is coming in and he's affecting the system. Usually they do it on these levels. It's amazing how once you start to track it like this, you will see how they came on these levels with this excess of gamma and they have an effect on the market. Now, what other level is important to me? Um, this one, which is the minimum of the previous of the overnight session, right? So if I see here, why? Why is sorry, let me. So this level is quite important. Oh, let me show you in the other part, which is easier. Why is the minimum? Why is the low overnight is important? If you see the low overnight is here, 21,970, it worked as a resistance, right? Um, on the when the market opens on 22nd of January, it found resistance right here, and then quickly came broke it. But on the 22nd overnight, it was a resistance. Then it was resistance on the 23rd. Then on the same 23rd, it was resistance again, resistance again, resistance, 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 until it broke it up, and then it was support. So basically, it's the resistance became support, right? And that was the low overnight. And as we can see now, we can see it here. That was a level they tried to defend during the Friday session. But anyway, so these are the levels which are important for me. Why? Because I want to see these guys when they come with this high net convexity. These big institutions came in with this excess of gamma, and they affect the market. And I want to have those levels. And if I find confluence between the levels and these levels of the daily technical levels and these levels of gamma, you're gonna find a profitable trade. And the way Jasper told us how to trade is amazing, and I'm gonna show you how, because it's very, very. I think it's quite profitable, because your stop loss is very tight, and that will magnify your take profits, right? So now that I have my levels, I'm gonna show you how I operate the market with an example of my trades on Friday, right? So if we go here, Friday opens, start to go low, right? Start to trade lower, and we find a low at let me see, what time is it? Around, here we go, 21,991 was the low, more or less, on at 9:38. Sorry, 9:38 in the morning. What we have in here, we have a level of gamma, right? The first level of gamma. Uh, the price didn't touch it, didn't cross it, and it found some resistance. Some support. So you see how these levels, this excess of gamma, the way I understand it is, don't look at it at, oh, is it the client, is it the market maker? No, it's an excess of gamma, right? So we know there are these levels where institutions came with excess of volume, right? And they affect the system, and the price tends to work as these levels tends to work as a support or resistance levels. So here we saw how the price tried to came here, and it works as a support, and actually it was rejected, and it started to trade up. Let me open this a little bit. All right, so that's already quite an important level, right? We have data at 9:40. We have data at 9:45 PMIs, and then at 10 o'clock Michigan sentiment, if I'm not wrong. So basically, I do prefer, I wait for the data. I don't like to trade on the times where we have data. But, and I'm gonna show you how you could make your first trade and make some money easily with the gamma, right? So have a look. Clearly, right, one signal is like we were trading lower, right, and then we start to do higher high, higher lows, higher high, higher lows, right? I didn't trade this, but the way to trade with gamma is, for instance, the price cross from below to above this excess of gamma. So you could have gone long at 42, right? 22,042, and then you put your stop loss below the next gamma level, which is this one at 28, or let's say 30, right? So you put your stop loss at 30. It's quite close. It's just, I mean, it's a tie stop. Is 10, 12 points. And what's your target? Your target is this next level of gamma, which is the 67. I want you to think of these levels. They are excess of gamma. But once the price found support in one of these, the logic of what you see more often than not is that the price will go and try to look for this level, right? This is like kind of a magnet. I've seen it so many times. It's like kind of magnet. They pull the price. So you could put your stop loss below here, go long, and put the target here. But bear in mind we have data, um, and then at 9:45 and 10. Now, keep in mind this negative gamma that just appeared, right? Just keep in mind, because I want to show you that why this was why this gamma was a resistance level, and why I went short here. Actually went short below, but I'm gonna show you that. So the price went up, as I said before, you see, it kind of pulled the price. It's a magnet. So it trade here. So this wouldn't be your target. You wouldn't make some money there. But at in this moment on Friday, I have a bias, a short bias, and I tell you why. So first of all, this is a target which was hit, right? Then we have this negative gamma. If we go if we go to, I always like to see where is this negative gamma coming from. So that negative gamma, negative gamma was coming from at 9:53 more or less. See, here we go. So that negative gamma was coming from these two bars, right? And if you remember, these two bars are selling off calls, which in nature are bearish, right? So whoever came in the market selling these calls was expecting the price to go lower. We hit an SX of gamma target here at 22,069, which is this one. So price trade a little bit above and then reverse, right? That's the first signal that tells you, okay, this is stopping. I could sell the market here and put a stop loss at 81. So you see how tight are the stops, right? So you could sell it here at 66, 67 and put the stop loss at 81 as very tight, or even you can put it higher, I mean to the high of the day, which was 74, right? But the way I traded was, okay, this is stopping, this is kind of a resistance, but because I know this is a selling of calls, I want to see the price to actually trade below this level, right? Because this is bearish in nature. And when we go to Gets profile at the time, right, we see how the price trades on this level and also reverse. But what's important about this kind of positive gamma? And this was the clue for me. If we have a look the documentation, it says gets profile default nets out imbalance calls against imbalance puts. Yeah, regardless of dealer or customers. We don't think this, oh, this is a client, this is a market maker. No, we just need to think this as an imbalance, right? And this is the area where the imbalance occurred when we have this imbalance exposure, right? They say we display call gets imbalance to the right, which is this one, and put get imbalance to the left, which are the red ones. And this is the key. This helps us quickly distinguish between high gamma nodes, this one, which are targets, here we go, and low gamma nodes, which are transition areas. All these low value nodes are transition areas. So this is a target, right? So we have three clues which are telling me, oh, this market is stopping. First one, we hit the maximum gamma or the excess gamma, price trade above this level and I couldn't and quickly came back, right? Secondly, we have this negative gamma, which is coming from selling of calls. And selling of calls, by nature, they are bearish. And on top of that, we have the gets profile, which is telling me high gamma nodes become targets. So market came from below to the target, found some resistance in the excess of gamma, and on top of that we have a selling of call which are like bearish in nature. So at this time I say, okay, so what I'm gonna do, I'm gonna sell this market, right? Where? Well, I'm gonna sell it. Oh, sorry. I'm gonna sell it when the price trades below, trades below that maximum negative gamma. Why? And my first target will be any one of these two, 39 or 29. And I have to monitor the price. So I went short, My first trade, I went short of 51, more or less 51, right? And I was looking to 21. So that's what happened. Oops, that was very quick, sorry. Let me put it back. Here we go. So I trade back, I trade short. I went short at 51 and I took profits at 29 because it was very quick. The market just trade very quick and it went to my target very easily. Okay, so we can see the market keep trading lower, and I did a second trade and I'm going to show you where. Here we go. So this was my second trade. You see, I didn't trade while the market was here between this high of excess of gamma, because you see what happened in the middle between levels. You have these kind of nice moves, but inside these two, inside the excess of gamma, you have kind of these fringy markets where you usually get a stop out. Right, so my second trade, I went short at 22,007, right? But at this moment, I have a problem, right? And I say, well, where's my target? I don't have any gamma near which can work as a target. Um, so my first target, my first idea was like, okay, if this was the low, like 21,995, that could be an area to take profits. But the second option I had was to wait to see another level of gamma, right? And that was exactly what happened. Here we go. Here we go. This is my second level. This level of gamma was my target. So I was waiting for my target. Market start to trade lower, right? And hit my, oops, sorry. Miss my target for just a bit, right? So basically, as the market was trying to approach to my target at this gamma level at 79, it actually disappeared, but doesn't matter. I just leave my target where it is, right? Because I know I have a target here. I have a gamma, sorry, an excess of gamma. And they reduce the gamma. We can see with the dots, they reduce the gamma, sorry, right? But doesn't matter. That's where that's where you have to put your target, right? And market nicely took my second profit, right? And I make a mistake then, right? And I'm gonna say here, and I'm gonna show you why, so you don't make it. So I have two trades in profit, right? And as you can see, let me put this one to the left. We have another level of gamma which appear just here at 79, right? More or less where I took my profits, then they took the gamma out, then they put it back again, right? So what was my mistake, right? Remember, I have to wait in the way to trade this, the algorithm to trade this is you need to wait. If you're bearish, you need the price to trade below your level, right? Your excess of gamma, and then put the stop loss above, right? What happened? I was so excited that I was right, that my bearish view was working, that I went short here. But I didn't wait for the market to trade below because I was so confident. But that was the mistake, because I need to wait for the market to trade below the excess of gamma. It didn't, and it started to go higher, right? So at that time I said, oops, well, my stop loss is going to be above this 22,009. If it breaks above, I'm out, right? That wasn't the best risk management, to be honest, because what we want with this gamma profile is like put high stops and try to look for big targets, right? So we saw the market actually went to my stop loss, right, on that position. Here we go. You can see there. Market went to stop loss. Let's put it like this. So see, this is the market trading. Hits my stop loss, and all I have to do there just was like just wait. Because what happened, if you don't put your stop loss on top, you have all these gamma levels, excess of gamma, that, as I said before, they can work as a magnet and they can pull the price, right? But look what happened. You don't trade on these purple levels, but you just wait for the excess of gamma, which are the blue ones. Market goes to this level, 29, and quickly, we all saw that, went down. You just didn't have time to sell. It was so quick, right? But now my short bias came back, and all I have to do was like to do a little bit of structure analysis, like market structure, and wait for a big level of gamma. I'm gonna show you something that I learned from a very good futures trader, which trades no market. It trades with market structure basically, and he showed me something. He's a very good trader. He showed me something that I was like, oh my god, he's right. Let me show you here. I'm gonna take a screenshot so I can do it. So this is the way I trade on Friday my short, right? This low, which I think I forgot to mention, why this low is so important, right? Well, this low is the overnight, sorry. This one is the overnight session, right? Have a look at this level. Is this level here that was resistance, it was resistance, it was resistance, 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 now is support, and look what happened. On that day, on Friday at 11, between 11 and o'clock, it found as a support again. So basically they were protecting this level, right? And I didn't see it. I didn't see it, to be honest. I marked the level, and I made two mistakes. The one I showed you before. I didn't wait for the price to trade below the gamma level, and I kind of totally forgot to check my overnight level. And it was Jasper who put in the chat, guys, be careful, that was the overnight level. And we're like, oh my god, you're right. Well, but anyway, I'm gonna show you something very interesting that I learned from this guy. Usually, how traders analyze the market, they say, okay, this is a high, sorry, this is a high, this is a low, this is a lower high, right? And this, they were expecting to make a lower low, right? But it didn't happen. So actually went up, grabbed liquidity, and tried to break it again. But have a look this. If you see the market structure, right, like this, so the price tried to break the level, that overnight session, first time here until here. Have a look the time that it took. Have a look the time. So buyers they were strong to reject the price, right? Sellers were like pushing really hard to sell. They found support on this level, which is an important level, the overnight session. Buyers pushed the price high, and then sellers step in again, right? Now, what happened the second time? Have a look at this. So the second time, buyers tried to push the price higher, but they couldn't, right? Now we have a lower high. But the important thing is, look, every time the time is less and less. So buyers are becoming weaker and weaker. They are not able to push the price higher and to repel the selling, right? They are not able to do that. So have a look what happened the third time. Here, is smaller, right? Look, the time that is taking for this bears to push again and try to break this level down is smaller. Look, you see the time is getting shorter and shorter. And it's going to put it in red. So the last time, look, is just even shorter. And this is a lower high. So you guys see what's happening. Not only we're making lower highs, but the bulls are becoming weaker. We see in time, sellers are taking the lead and bulls are not able, to repel the price. They are not able to push the price higher. So with this information in mind, I thought, all right, I got a high probability they're going to break this level, but I need to wait for a gamma to show, and I need to wait for the algorithm. I need to see the price to trade below the gamma so I can go short, and I can put my stop loss here, or my stop loss above the high, or my stop loss above this high, right? And that's exactly what happened. So let me see where I put the, not this one, right? So I have my level, which is the 21.966 low overnight of 71, and as the price, let's put it again. So we are here, right? And look, this is my level of gamma, which is telling me not only the way I see it, I don't know if I'm right or not, but there is a big institution here who came and interact with the options market. And I'm pretty sure they want to sell the market, right? All I have to do is wait for the price to trade below this level, right? To trade this level. It goes up. And now, here we go. This is when I went short the market. So the market, let me put it bigger. The market tried to, it's coming from above, right? It's making lower highs. It goes to this gamma level and then trades below, right? So this was my trade, and I was so sure that they were going to break the market that I sold a big position here, and I put the stop loss above here. And once the market broke the level, right, on the downside, right, look, the gamma disappear, it doesn't matter. I still have my stop loss. I still believe that position is going lower. And my first target it was 21,889. That was my first target, right? So the price trade below, right, broke the level, and I went heavily. I short more contracts, right? And to be honest with you guys, because I didn't have any gamma in the middle, when the price came here and it started to reverse, I took profits on half of my position. And I say, okay, the other half, I'm going to put it in break even, or I'm going to look for this gamma level. And that's exactly what happened, right? Here we go. Market is continuing to go up. There is no more gamma. The next important gamma is this one. So this is another institution that came into the market and create this excess of gamma, which is an important level for us to trade. And that's where I took my profits, basically. So market goes there, right? Goes to maximum of negative gamma, and that's it. I took my profits, and I was quite happy with that. There is something I want to show you, which is important, or I want to, tell you again. Only trade on these levels of excess of gamma, right? And you have a bias, right? Try to understand the market and try to see what's your bias, right? Your stop loss has to be very tight, right? And you need to look for the next nodes of excess of gamma, right? And that you will be fine. But I want to show you something really important. which is like kind of look with a magnifying glass what's happening. You see this level, um, which is the overnight low, which was defended so many times, right? So the people who study technical analysis of, belief on these lines would say, oh, yeah, this is a support, 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 support. Now, when we go, was the second time was 12 of 8. Let's go back here. Here we go. 12 of 8, more or less here. Oops. Right, we see the market is being defended. But why? Of course, we have the overnight low. We know someone was defending. But something interesting I saw in option profile is this. 12 of 8. Have a look this. Right. What we have in here, right? Remember, don't think, oh, this is the client or this is the market maker. Just think as these levels are levels where there are excess of gamma, right? And although this classification is by volume, which is quite good, look what we have in the level that we are trying to that the market was defending. Here we go. 1 second. Let me see. It went up. Look, we have a selling a put, right, which in nature is quite bullish, and on top of that, we had at that day a combination in the same level of selling a put and buying a calls. So imagine you have this big barrier, and the institutions trading here, they wanted the price to go higher. Obviously, buying a call is bullish by nature, and selling a put is bullish by nature. And have a look what happened. Let's keep going. They almost manage to kind of put the price higher, and we have two institutions coming in two different levels doing the same. I don't know if it's the same institution. I don't know if they are different institutions. All I know is like when these people came into the market on these levels and interact with the options markets, right? And creates this structure which is by nature support, because you're buying a call, you're selling a put, that's support, double support. And in this one, you're buying a call, you're selling a put, that's also double support, right? So yes, we have an overnight low. We saw that it's been defended, but why? Look, we look with magnifying glass in the options profile, and we saw institutions or big players trying to push the market higher by buying calls and selling puts, right? So that's something quite interesting to see on this options profile, right? Well, that's it. That's what I wanted to tell you guys about the way I trade, the way I understand the market. And again, you know, Gexbot, they have done an amazing job, Jazz and John, creating this model, because the more I use it, the more I think, right, they're right. If we see only these big institutions coming into the market with lots of money, right, and they are coming here and they are and Gexbooks classify the excess of gamma, well, we only have to do a little bit of market analysis, right? Establish some levels and wait for the excess of gamma to come into the market. And then we trade level to level as in here. Um, as in here, yeah, we trade level to level. We put a tight stop and we try to go to the next level of gamma, excess of gamma, and then we go to the next one, because by nature these ones are kind of mean reverting and trying to look for the next one, right? So that's the way I see the market. That's the way how I trade it. And please just, well, I'm happy to answer questions. I'm not obviously the best. I'm still learning a lot, because what I do recommend you guys is because going to the resources, yeah, I study the metrics, I study the docs. You also can go into the Discord channel, right? Go to these theory questions, right? You can ask any questions, and you go there, Jazz and John replying previous questions, and that's amazing, right? So you can learn a lot from them. So anyway, any questions? I'm happy to answer in Discord, and I hope this video is useful for you guys. Cheers. Bye.